Hey, what's going on, everybody? Welcome back to the channel all about real estate. My name is Lewis, and today's video is going to be awesome. We're going to be talking about whether or not we are in a housing bubble, and to do that, we're going to look at an article here from Fortune where they show a short video clip, and they discuss the difference between price deflation and price deceleration. And we'll let you decide which one you think we're going to see. Now, if you are new to the channel and you like all things finance, real estate, and investing, please consider hitting that like button, hitting that subscribe button right there. And if you wouldn't mind, please leave a comment. The comments really help me as well as others learn and grow. And without further ado, let's jump right to that video clip. All right, so up on the screen is the video clip talking about what the future of the housing market will look like. I'll go ahead and link to this in the show notes if you'd like to review it yourself, but let's listen to what Lance Lambert has to say.
The outlook for the housing market for the rest of 2022 is one word: deceleration. Real estate research firms from CoreLogic to Fannie Mae believe that home price growth is about to slow. But keep in mind, price deceleration is not declining prices. It just means home prices going up at a more moderate rate. The more dangerous scenario is if spiking mortgage rates do not rein in the run-up in home prices. We could see ourselves go to a housing market that reaches dangerous levels. Home prices on an annual basis are climbing at about 20%. That's 5 times greater than the growth in incomes. If that continues, we could see ourselves in a housing bubble.
He's stating that some of the economists do not think that home prices will actually come down. Rather, they will just taper off, or we will see less price growth. Obviously, we can't sustain a 20% year-over-year price appreciation, especially with rising interest rates and wages not increasing alongside of those levels. Now, we are already seeing decreased affordability across the board. I think I read a statistics that said that affordability is now rivaling that of the 2005-2006 peaks that we saw leading into the great financial crisis. So we are getting to the point where we are at what feels like a bit of a market top here. But from the gist of it, he's saying that the fundamentals are still strong, and they're really predicting that things will not come down dramatically. So let's hear what else he has to say here.
At the onset of the COVID-19 recession, the Federal Reserve immediately pushed rates lower. That saw mortgage rates fall to historic lows around 2.6% on 30-year loans. And throughout the pandemic, that's actually acted as a buffer for homebuyers who've been seeing prices soar. Getting in those lower rates helped them to absorb those higher home prices. But now, over the first 3 months of 2022, mortgage rates have spiked over 1.5 percentage points. And that's adding about $400 to the typical new mortgage. And what that does in the short term is a lot of home buyers are rushing into the market to try to buy a home before rates went up. So that made this spring market even hotter. But on the tail end, and what we're looking at this summer, is an affordability pinch where buyers should start to get priced out of the market. Some borrowers will lose their mortgage eligibility and we'll have fewer buyers.
Okay, so absolutely true. Now, he's saying that the lower rates actually helped buyers afford homes that were increasing in value. And I would actually argue that the lower interest rates drove or fueled some of the higher price growth that we saw. We saw a huge increase in investor participation in the market, as well as second and third home buyers that wanted to buy, vacation properties and things like that. And part of that had to do with these low interest rates. And from an investor standpoint, if you can go out and secure 30-year fixed rate debt at, let's say, 3%, and inflation is running at 8%, that delta, that 5% difference there, is an exchange. It's basically a transfer of wealth from the bank to you. And a lot of people really understood that because they're looking at it and they're going, look, based on inflation, I'm basically borrowing for free in real terms. And on top of that, there's a massive amount of debt pay down in the meantime, because the lower your interest rate is, the more that you're paying to principal each and every single month. So I think that alone drove some of these prices up. Now that we're starting to see interest rates go up, I think we're starting to see housing prices actually cool down. And to their point, it is pricing some buyers out of the market, and it's really sad, especially for first-time home buyers who want to get involved. They want to buy a home. They value home ownership. It's still the American dream. And they're just getting priced out of the market. If they qualified for a home at, let's say, $500,000 before, well, the rise in interest rates might have pushed them down to $400,000 or $420,000. And right now, it's very hard to find a home for sale in that price range. Now, it's different across the board in different markets, but I can tell you from what I see out in the Northern California market, the median price home out here has got to be somewhere in the fives. I mean, it is.
When it comes to material cost, builders are not having an easy time. They're seeing delays and surcharges for everything from windows to concrete to appliances, and of course, everyone knows lumber. That hasn't eased up yet, but if the economy starts to grow at a little slower rate and some of the supply chain issues are fixed, that should give a little bit of an ease up in the rate of growth for new home prices. But don't expect builders to pass on those savings to buyers. It's really just a factor of it's going to slow down the growth of prices.
So home builders are having a really tough time right now. I mean, we've seen labor costs go up dramatically. Builders have had a very tough time finding willing and able employees. They've had to increase their wages just to retain them and keep them working. On top of that, you've seen the supply chain issues with material costs skyrocketing across the board. So lumber costs are up dramatically, cabinetry costs are up, material costs are up, supplies are up, all of that. So it's increased the price per square foot to build all of these homes. Now he's saying that they're not gonna, home builders are not gonna go ahead and pass on this savings as things normalize. And I would agree with that. The only part that I would disagree there in that case would be if interest rates continue to rise and we get some pressure on the housing market. Builders may be in a position where they have to start reducing their prices or offering incentives just to move product. But I do think that we could see some issues there with those new construction products if affordability is an issue for most of those buyers. I mean, if you think about it, the lead time to build a house is, let's say, roughly 6 months. So a would-be buyer is going directly to the builder. They're trying to lock in a price. They're trying to secure a property to purchase a home. They do it 6 months in advance. Well, if they did that 6 months ago and they were looking at rates that were 3%, and now, fast forward 6 months, they're looking at rates that are 5.5%, the cost to purchase that home and secure that loan has gone up dramatically. It's making a really large impact. So I think in some cases, buyers that were maybe on the cusp, well, now home builders may see a higher cancellation in contracts. It could put some more added pressure on them to reduce prices or offer higher incentives.
Real estate research firms, housing economists are pretty certain that they don't see us heading into a housing crash right now. They believe that the rising mortgage rates should actually be a healthy thing. It should help to slow down the unsustainable levels of growth in the housing market. They don't believe that we've necessarily reached a level where we are anything close to a 2008 housing bubble, but they believe that right now we need to see the market slow down.
All right, so there you have it. A lot of these economists, I guess, are saying that they do not see a reduction in housing prices. They do see the market having more legs or the ability to run even further and go even higher. However, they are stating that mortgage rates going higher will actually normalize the market. The sad truth in this is that the higher cost to borrow means that we're pricing many buyers out of the market, and a large portion of that would be first-time home buyers who make up about 30% of this market. On the flip side of that, I believe that if rates continue to move higher, we're going to see added pressure, and you will start to see prices come down a little bit. Now, we are starting to see price decreases in some markets. I know here locally in the Sacramento region, we are starting to see an uptick in price reductions. However, I don't really know whether or not those homes were just priced incorrectly to begin with, or they were just, kind of thinking, oh, the market is so hot right now, let's punch out the property at a really high price. That, I think, is going to take time to unfold, and it'll take time for us to see what actually transpires in this market. So anyway, what do you think will happen in this market? Do you think we'll see prices come down, or do you simply think that we'll see price appreciation decelerate? Let me know in the comments below. We would love to hear from you here. And if you haven't done so already, please consider liking, subscribing, and we'll see you on the next video.